Hello everyone, and welcome to the Mines and Money panel discussion on meeting stakeholder decarbonisation requirements and how well miners are managing the energy transition. My name's Tim Power. I'm an environmental and climate change lawyer and partner at White & Case, and I'm delighted to be hosting a panel this evening with four fantastic panellists. I'd like to introduce firstly Froydis Cameron-Johansson, who's the Group Head of International Government and Sustainability Relations at Anglo American. And Anglo American has set a very ambitious goal of carbon neutrality across its operations by 2040, with 8 of its assets to get there by 2030. Second panellist is Stephen Barrie, who's the Deputy Director of Ethics and Engagement at the Church of England Pension Board, where he works across the board's investment stewards activities. He's previously served as Secretary of the Ethical Investment Advisory Group, which advises the 3 Church of England investing bodies on ethical investment. Our third panellist is Matt Griffin, who's a co-portfolio manager at AMP Capital. And AMP Capital itself has announced a 7-year renewable power purchase agreement with Diamond Energy for its wholesale office fund. And our fourth panellist is Gloria Karaiskos, who's the Director of Climate Change at the Carbon Market Institute. And Gloria brings over 10 years of diverse experience in consulting, technical and operational roles, and has worked with some of Australia's largest organisations, focusing on business investments in carbon, energy and sustainability practices. I think this is a really topical and fascinating matter for us to discuss this evening because of its import for the mining industry. The last 2 years have witnessed a remarkable change in public and investor sentiment and expectations about what companies should be doing to advance sustainability and environmental and social governance issues. To varying degrees, these changing sentiments and expectations are affecting all industry sectors in all parts of the globe and across the full gamut of sustainability issues, be it water quality, be it air emissions and health impacts, be it having respectful and meaningful partnerships with traditional owners and other community members. But no issue has captured more attention and presents greater risk to unprepared business than climate change. And with the possible exception of the oil and gas and petrochemical industries, it's hard to think of any other industry of whom expectations are higher or the challenge is greater than the mining industry. And it doesn't take much reflection to realise how rapidly things are changing. About 2 weeks ago, a court in The Hague ordered Royal Dutch Shell to reduce its global greenhouse gas emissions across the entire Shell corporate group by 45% by 2030 relative to 2019 levels. That's remarkable. And just last week, the Federal Court of Australia found that the Commonwealth Minister for Environment owes a duty of care, common law duty of care, to Australian children, even when deciding whether to approve a coal mine extension under Australian environmental legislation that has nothing to do with climate change. So, and legal claims relating to financial disclosures and fraud, and increasingly claims relating to potential breaches of human rights laws are extending to places as diverse as Holland, to France and South Korea. And all of this raises the profile of climate change risk in the community and escalates the risk of inaction. And another key development, which we'll just no doubt discuss today, is the demand for investors to see transparent corporate benchmarking and reporting on climate change and sustainability issues, wishing to see a sustainability dividend on their investment, as well as a financial one. But this in turn has resulted in an alphabet soup of acronyms, each representing different sustainability and climate change reporting standards and guidelines: TFCD, SASB, GRI, CBD, CDSB, and so on. I think it's fair to ask not only whether there's a need to simplify these reporting frameworks, but is there a risk that we're all more concerned about ticking compliance boxes than achieving sustained and meaningful climate goals? So, having given that introduction, I'd like to turn to our panelists and ask firstly, how are clients, and mindful of this environment that we're in at the moment, how are clients prioritising their decarbonisation investment? And Froydis, I wonder if you could talk to us a little bit more about Anglo's decarbonisation strategy and what its objectives and what it's doing.
Thanks, Tim. Really great to be here. So nice to be on such an esteemed panel as well. I think your introduction captured just the importance, and I think one of the biggest things that we at Anglo American are really appreciating is the speed of change in this space. So if you think back to where we were, 2 years ago, let alone 4 years ago in the climate space, it was very, very different. And I think that's one of the things that companies need to really be keeping front and center is whatever your requirements are today are probably going to be very, very different next year. So, we're not even looking at a 2-year time horizon. It's very much thinking about the next 12 months. And I think the disclosure space is a real example of that. So from an Anglo-American perspective, climate change is very much front and center of how we think about things. It's very much on the agenda of the board, of the executive committee, and actually the lead executive for this, along with the CEO, is our group head of strategy. So that's the weight of the importance that we put on climate change, is that it is hard-coded into our strategy thinking as well. You mentioned these sort of very ambitious climate goals that we have. So again, carbon neutral across scopes 1 and 2 across all of our operations by 2040, with 8 of our assets being carbon neutral across scope 1 and 2 by 2030. We also appreciate the kind of real interdependency between water and biodiversity within the climate space. And so we've also made a number of commitments around net positive impact with respect to biodiversity as well, because we think, again, in terms of resilience and abatement, we do need to be looking at some of the nature-based solutions as well, especially for some of our communities in some of the more climate-stressed areas. In terms of our sort of overarching strategy, in order for us to meet those goals, we've got sort of 5 areas that we're sort of focusing on. So the first one, these are not sort of rocket science in many ways, but the first one is, improvement of efficiency. I mean, that has got to be the first thing that everybody looks at. How are we just being more efficient and effective with the resources that we have? Investment in technology. So our Future Smart mining sort of program is our sort of purposeful innovation, really with respect to sustainability. So how are we reimagining mining to improve people's lives? And a big, big part of that is innovation. How are we really rethinking the footprint that mines actually have? And the footprint, not just in terms of space, but water, carbon, and biodiversity as well. Switching to renewables, again, not rocket science, but that is so much more available than it used to be. There's still a long way to go, and there are still a number of challenges, but that absolutely has to be a key part of people's strategy now, is to switch over their energy sort of baseload sources. Transition the portfolio, you'll have seen this week, we actually listed our Thungela resources in South Africa, so thermal coal business. So again, really thinking about, what are the metals and minerals and materials that are needed for a low carbon future. And Anglo's been on a portfolio transition for a number of years now, as you'll have seen that we're really shifting towards those products that are for a sort of greener, cleaner, and more sustainable world. And then finally, is the balance of residual emissions. So again, there's a lot of discussion around offsets. We believe that offsets are really there to really manage that last, really difficult piece to sort of abate, but that shouldn't be the kind of core premise of your strategy. You need to be looking at all the other levers, and only when you have exhausted all the other opportunities should you really then be looking at how you can manage that balance of the residual. So that's the 5 sort of core pillars from an Anglo strategy perspective. We are by no means there, but we're definitely on the journey, and still a lot of work to do, not just with our own operations, but also working very much in concert with government and other stakeholders as well.
Froydis, thank you. And I'm just to be interested for a institutional investor perspective on this question. Stephen, I'm wondering if you're able to share your thoughts on this question about what clients, how clients, or whether clients are prioritising their decarbonisation investment.
Thanks, Tim. Thanks for the invitation. It's great to be here as well. I think it's probably worth dwelling for a second on the weight of capital that is lining up behind decarbonisation. So you've got the Paris-aligned investor initiative of the Institutional Group on Climate Change, which has got about $33 trillion of assets under management behind it. The Climate Action 100 Plus engagement coalition with about $54 trillion assets under management, and by some estimates, that's half of all professionally managed money around the world. So real significant coalitions developing and implementing pretty robust analysis of transition risk, with the goal of driving change in the real economy. And at the heart of our approach to transition risk and also Climate Action 100+ is the Transition Pathway Initiative. And if attendees haven't come across the TPI, please do. It's publicly accessible assessment framework, and the methodology for diversified miners is particularly worth a look. The methodology is available right there. But it asks the question, what are the major transition risks for diversified miners? And finds it in Scope 1, Scope 2, and Scope 3 emissions. And TPI challenged the industry to come back with a better methodology than the one proposed by TPI, and none was forthcoming, but it uses a copper equivalent emissions methodology to look at Scope 3. And Scope 3, TPI has found, covers about 92% of all tracked emissions for diversified miners. So it's certainly material, and transition risks will come in from changes in demand.
Am I able to ask a follow-up question there? Just what weight do you give to transition risks, and how do you quantify that when making an investment decision? Do you have any thoughts to share on that, Stephen?
Absolutely. Well, TPI provides the assessments. It provides assessments on management quality, which is kind of a climate corporate governance measure, and carbon performance, which is a forward-looking measure of carbon intensity. And the way investors use that is various. So it's incorporated into proxy voting and shareholder resolutions. It's incorporated into our asset manager monitoring frameworks. It's used for investment tools like the passive index, the FTSE TPI Climate Transition Index, which overweights or underweights companies in that index on the basis of TPI assessments. So, for example, a company that is assessed by TPI as not being in line with the transition, or not disclosing forward-looking transition risks, forward-looking carbon emissions, gets a 0 weighting in the index. Now, it's not quite disinvestment, because if they publish transition plans that fall in line, then they'll be included in the index, and then potentially even overweighted if their carbon emissions are in line with a 2 degree or below 2 degree sector-specific scenario. But that's kind of an example. We allocated £800 million sterling to that to track that index last year, which is the entirety of our passive holdings. And we like the fact that it links to corporate engagement, so that the goals that we're setting companies when we engage with them has a direct reflection then in the passive index, in the investments that we make.
Stephen, thank you for that. That's fascinating. I was just wondering if we could turn to another topic, which is the question of voluntary carbon credits and voluntary carbon credit markets. Froydis mentioned earlier that Anglo's thinking of them credits as or offsets as being, my words, not hers, perhaps a last resort on the path towards net zero emissions. I wonder if, Gloria, if you can share with us your observations or thoughts about what role carbon credits and voluntary carbon markets have in achieving net zero targets, and what are some of the current trends you see as being important in this field?
Well, thank you, Tim, and yeah, pleasure to be here joining the panel today. Look, with the groundswell of net zero commitments, of course, there's been an increasing amount of voluntary activity, I guess, in the carbon market and all across the economy, especially in those heavy emitting sectors that we've spoken about: oil and gas, mining, of course, aviation and transport. Organisations seem to be sourcing those offsets, investing in offset projects, or entering into long-term offtake agreements with some of their suppliers, and even scooping up some of those organisations with significant experience in carbon project development as they look to bring those capabilities in-house. So there's definitely a lot of activity happening on that front. But of course, the reality is that we do have to reduce and offset our emissions and avoid them, in fact. So today, if you wanted to be carbon neutral, you're very likely going to need offsets. It's not really possible to completely decarbonise your activities today, either due to cost or technological barriers. But of course, longer term, achieving that state of carbon neutrality or net zero, as many organisations are aspiring to, is going to require quite a change in the way an organisation operates, in particular when it comes to the mining sector, just due to the nature of its operations and its emissions-intensive activities, of course. So I guess that mitigation hierarchy around avoid, reduce, offset should be paramount in an organisation's decarbonisation approach. But it's also important to note the positive impact that the investing in those emissions reductions and projects can actually have, not only on carbon emissions, but as Froydis mentioned, some of those other co-benefits that we're seeing. So things like broader environmental and biodiversity benefits that come with nature-based and land sector projects, but as well as some of those social and economic outcomes that these projects can bring to communities and employment. So without that kind of early investment into those projects that address climate, many of them wouldn't be able to go ahead. So it's also this investment that can help direct some of that early finance into those negative emissions technologies that are emerging, because the science tells us we are going to need that. So net zero is great, but we will need to get to net negative, which is basically sucking out more greenhouse gas than we're putting in the end. So investment in those negative technologies and that kind of permanently remove and store the CO2 and other potent greenhouse gas emissions is pretty key to this. At the same time, you should continue to focus on those emissions reduction activities that you can do now, be that within your own operations, within your value chain, or even beyond that as well. But I guess importantly, when it comes to the carbon marketplace, there needs to really be a strong framework around it. Ensure an offset market's got high integrity, transparency, the right governance frameworks are there, really to make sure that those market-based activities and offset projects are credible. I think investors and stakeholders are becoming more attuned to those targets that lack credible plans and pathways to achieve them. So we're seeing a lot more of that now. We've gone from target setting to now planning that pathway of decarbonisation and moving into action. Earlier this year, we had another legal opinion in Australia on climate risk and disclosure that warned that board directors could be sued for misleading conduct if they were found to be greenwashing their commitments to achieve net zero and address climate risk. So, more recently, we've seen the G7 back mandatory climate risk disclosure reporting, TCFD, that another acronym there. Many believe it's only a matter of time before that's formally mandated across all the major economies. So that's kind of what we're seeing at the moment on that front.
Yeah, Gloria, if I may ask a follow-up question, if you've got any thoughts about what role government or governments should have, if any, in if not establishing, then at least regulating markets. So there is, if you like, the quality assurance around the integrity of the credits and the integrity of the market. Do you have any thoughts or observations on that?
Yeah, look, market integrity obviously continues to be a very important factor and a key focus area when companies are engaging and investing. And it's not an excuse. I mean, offsets are not an excuse to continue with business as usual operations. Globally, we've seen the establishment of that task force on scaling voluntary carbon markets, TCVCM, I think, which is a private sector-led initiative looking to really strengthen and scale that voluntary market. And that task force is backed by the International Institute of Finance. And in its blueprint that it put together last year, said the market by 2030 could be around 50 billion. So one of the elements they're looking at that as well is obviously the governance of that and whether or not that would be better suited to a government organisation or private sector entity or someone who's kind of at arm's length from that front. So yes. Definitely important that we've got that, transparency, integrity. The offsets can be traced and verified. The projects themselves have environmental integrity, and it's really, what the task force is setting out to achieve. But a little bit closer to home in Australia, of course, we have this Climate Active program, which is government-backed, and that's, I guess, more so for smaller organisations or products, and we're seeing the uptake just be huge in the climate active space, and that I guess is backed by government and has a lot of requirements around what those kind of eligible offset types are, and it's really important that they pass that kind of integrity test around the principles and standards that enables the government or whatever governing body might be in a broader kind of global market. Might be in the offset front. So making sure that activity is taken place, it's measurable, it's registered on a register that can be publicly tracked. It's additional in that it wouldn't have gone ahead without the investment. It's permanent abatement. There's transparency. Auditing frameworks are sitting around it. So governance is a big thing for maintaining market integrity.
Gloria, thank you for that. Now I'm going to poke the bear a little bit and ask Matt. I might direct this question at you. I'm just wondering if you've got any thoughts about how we hold people accountable for achieving their net zero targets, and when do we know if an organisation or a company achieves its net zero targets or emission targets, and what happens if they don't achieve it? Do you have any perspectives on those types of challenges, those types of accountability and enforcement challenges?
Yeah, definitely. It's a very, very interesting question, Tim, and actually something we've been grappling with a bit here, because we've started to see over the past year or two a whole range of companies come out with great targets to decarbonise or go net zero by 2030, 2040. The issue and the cynical part of you says, well, it's quite easy for management teams and boards to come out with these grand targets, knowing full well in 2040 they won't be around. And there's actually a few examples of, there was a large energy company here which came and met with our ESG team, had all the targets for decarbonisation and using credits and all this sort of stuff. And when our team actually did the numbers behind the cost of that, they worked out it was going to pretty much wipe out their entire profitability and send them broke. So clearly the granularity is lacking in some of the plans. I think some companies are doing it very well. Some companies probably aren't going to the level of detail to really show the roadmap and are more just focused on the big sort of headline. So the enforcement of that and who's auditing it, who's tracking it, I think that's really going to be quite a big issue, and potentially there needs to be some kind of mechanism to hold boards and management teams accountable for this. We're seeing a lot of shareholder votes come in, around decarbonisation and various ESG measures, and I think that's potentially one way to link performance on these decarbonisation measures to actually hold a company accountable for them. But I'm very interested if anyone else on the panel has actually got any thoughts on this, because it is something we're sort of thinking about, and cynically, I just don't think that a lot of companies are actually have the roadmap sorted out. And I think a lot of them are saying, well, technology will change and, can rely on hydrogen in 10 years and that'll help. But, what actually happens if companies miss milestones and aren't going to reach the targets and sort of delay them? Yeah, if anyone on the panel's got any ideas, I'd be.
Or if we don't have negative emission technologies, for example.
Exactly, yeah.
Does any panelists wish to chime in on this topic?
Yeah, I'm happy to offer a quick
Thank
view.
You,
so I think ultimately the market is going to hold companies accountable in a number of different ways. So I think increasing kind of consolidation around investor expectations, I think increasing kind of regulatory scrutiny around carbon, around decarbonisation. I think there's kind of an inevitable policy response, in the words of the PRI, the Principles for Responsible Investment, that's coming. Our trustees are pretty clear that climate change is a long-term material risk for our investments. It's a systemic risk, and that means that there's effectively no company in the world that's going to be immune from those kind of risks. And I think the market will operate in a number of different ways. So not just through engagement or divestment, but also thinking about debt, corporate debt, and that's going to be more expensive if a company is comparable to its peers on the transition and doesn't have robust plans in place. So ultimately, I think we'll get to a point where the market can quite clearly hold companies accountable. But in the meantime, there are plenty of institutional investors and asset managers who are doing what we can with the tools available to us at the moment.
Thanks very much, Stephen.
And just to add to that, I agree completely with everything that Matt and Stephen have said, and I think we're seeing that very much in terms of investors voting with their dollars and where they put the money. I can only talk from our experience at Anglo American, and there have been some really robust debates about what we do and don't put out. To Matt's point, there's a lot of pressure from investors to say, "Where's your target? Where's your target? You need a target." And to go to the tick boxing exercise, it was like, well, you need a target out, long-term target, put it out there, tick the box. But there's been a real reluctance at the very, very senior levels at Anglo to just do that, because they're like, well, we don't know how to get there yet. And so maybe, we come under criticism because we haven't released a long-term Scope 3 target, or, but there is a real appreciation that whatever we commit to, we want to make sure we at least have a really fairly good idea on how we're going to get there, because the executive and the board do take that responsibility incredibly seriously. So I think from our side, I think there is there's a lot of sort of investors there who have to, they don't have that much time to spend on companies sometimes. So they sort of have a scan through, have they got a target? Yes, no, tick. It's very binary, as opposed to, the engagement around, well, why haven't they got it? What are they doing? And is there a, just because they don't have a target right now, does that mean they're bad, or they get a sort of cross against their name? And it's about, I think, the sort of pressure to have the targets was now, but then as Matt said, the sort of interrogation of those targets is now what's coming.
Yes.
And how are, those targets that people have put out there actually really stacking up? And I think, with some of the targets that people have put out there, the chickens will come home to roost. And it's, from our side anyway, it's about being very considered about what we do commit to, especially given our kind of technology vision as well, to your point on, the sort of magic decarbonisation technology, is a sort of unicorn with fairy wings, which everybody is hoping for. But we want to make sure that, we have a fair idea of how we as a company are going to get there.
Froydis, thank you for sharing that. At the outset of this discussion, I made the comment that, or asked the question really, about whether sustainability and climate change risk assessments and reporting is being seen as a box-ticking exercise or not. And clearly, Anglo is giving a lot of thought to avoid just that very situation. But I'd be interested in perspectives from Matt and Stephen and Gloria as to whether they see this as being a prevalent within industry, or is this just is it not such of an issue at the moment, at least? Matt, do you have any thoughts on that?
Yeah, it's interesting, Tim. I mean, covering small cap Aussie listed stocks, especially in the mining space, they've been pretty slow to get up to the curve on ESG. If you think back a few years, there's not many small cap mining CEOs here which would have thought much about ESG and how to report that and reflect it to the market. That's changed. So we're seeing a lot of sustainability reports being released for the first time. I think there is a big risk, and a lot of companies are just ticking the box and seeing it as something they need to comply with. But just keep the investors happy, but do kind of the bare minimum. We're trying to work with the companies we invest in as much as possible to actually go, well, you can go through and tick the box on 20, 30, 40 different items or whatever it is, but we'd actually rather you just focus on what's actually really important and what can make a difference in the business. I think that there's been a general acceptance to that view, rather than just saying, well, let's appease the market and the proxy advisors and the voting committees, to actually change the view and saying, well, where can we actually make a difference to decarbonise our businesses and our portfolios?
I had a conversation with a chief executive of a mid-cap mining company about 2 months ago. We're discussing investor pressures on industry, the mining industry, to invest in sustainability and ESG and climate change. And he looked at me and said, Tim, no investor, I could invest in my new copper mine. I could invest in electrical trucks and vehicles on my mine tomorrow, but no investor's telling me I need to do that or should be doing that. Is that what I found that an interesting sort of observation from a mid-cap miner? I mean, what's the nature of the dialogue or the conversation that is happening or should be happening between a miner and an investor? I might start with you, Stephen, first, but I'd be interested in your thoughts as well, Matt.
Thanks, Tim. And I think picking up on the previous point as well, there's always a risk of tick box attitudes in every industry, ours included. Investors can be guilty of just sending a letter and calling it engagement. So in terms of the quality of the engagement, there's a really interesting kind of role for investors in encouraging boards to set targets, but not being too prescriptive at the same time. So the way that many proxy voting advisors decide on whether to support a shareholder resolution, or is it too prescriptive? Is it getting down into the micromanagement of a company's activities? And most investors are wary of instructing companies that they have an ownership stake in to, for example, buy electric machinery, because we're not well placed with the informational expertise to make a compelling business case internally for that. But what we can make a case strongly for is strategy and governance, and the kind of high-level goals that, if they're not backed up by a credible response from company management, are just a tick box exercise, but we trust will be, and that the machinery of corporate governance is there exactly to ensure that we can have confidence when a company does make a high level commitment like net zero by 2040 or whenever, that they can back that up, that they've got directors in place that have the skills and expertise, and the controls and processes to one of the most hideous words in existence, operationalize those commitments. So the kind of the role of the institutional investor here is operating at that level, rather than the kinds of influences that I think your CEO might have been expecting. But that doesn't mean that if he can work that into a plan that shows delivery of an element of a net zero, then brilliant.
Here's the minor, so he should decide. That's fair enough. Matt, do you have any other thoughts?
Tim, I think despite the weight of money flowing into ESG strategies and the focus on the space, I still think the vast majority of investors see ESG as a nice to have, as long as it doesn't cost them more money. So my sense is that the mining CEOs potentially going to investors saying, well, we can do electric trucks, but our costs are going to go up. And the average investor is probably sitting there going, well, actually, hold on, maybe we don't need this just yet. That will change, and the flow of money into ESG is only increasing in the focus and the regulations. So that's something that's changing quite rapidly. I think the other thing that's really changing quite quickly is just the market forces around the cost of that technology and factors like reliability. I mean, we've seen a huge amount of miners over the past few years start to put on-site solar generation and batteries.
Yep.
And that's replacing, if you're out in the middle of WA using diesel gensets paying 25, 30 cents a kilowatt hour, actually putting a solar in a battery will save you money, and positive IRR, you're getting a good ESG outcome, and you're actually saving your investors money. So I think these technologies are now reaching the tipping point where they're actually cheap enough to make financial sense, and that makes it a much easier decision to put dollars to work in that area.
Thanks, Matt. I was going to ask the panel about the scope for on-site renewable generation to meet the power needs of mines. So I might let's talk about operationalising ESG, and I wouldn't mind asking Froydis just whether you touched on this earlier, but what scope or role, or how important is renewables, do you think, to Anglo in meeting its long-term goals? Do you have a sense of that yet? And otherwise, where do you see, to use the expression, the biggest bang for your buck in terms of reducing your emissions, both presently, perhaps in the short term and the far term? Do you have any perspectives you can share with us on that?
Yeah, I mean, I totally agree with Matt. I mean, renewables is a really, really key part for us in terms of the kind of scope 1 reduction lever. I mean, it has to be. What else are you going to do? And I think the cost of it globally is just, plummeted. So it wasn't, before it was always like, well, you have to install it, it's the maintenance, it's all of the kind of upfront cost of capital to kind of do these projects. And then, of course, in some jurisdictions, land, it's not just like you have a small generator that you fuel. Solar parks take quite a bit of space. So I think for us, renewables is absolutely part of the strategy. And we've made we've signed a number of contracts recently in Latin America with renewable power suppliers. So we're really really seeing that Latin America is actually probably going to be our first sort of region where we're going to basically be able to use renewable for all of our scope 1 primarily, which will be fantastic. Anglo American's got a very large footprint in South Africa, and South Africa has huge renewable power potential. So lots of solar, lots of wind, And we're definitely, as part of our kind of South Africa decarbonisation piece, is looking at how we can actually, support South Africa's decarbonisation vision and their kind of commitments, especially under the NDC, where they're very explicit that they need to work with the private sector. Yes. And how we can actually work together to really build up and support that sort of accelerated installation of renewable power across the grid. Now, when we're looking at that, the big question mark with renewables, and I think they will solve it ultimately, but of course, is reliability. So again, how are you thinking about the reliability? And of course, the current thinking is to ensure reliability, you kind of have overcapacity. So what do you do with the kind of residual? And so what we're thinking of is, of course, well, you could utilize that to then make hydrogen. Hydrogen, of course, is a great vector for energy. Therefore, you could use that to power haulage. So, of course, massive scope 2 emissions across mine sites is around haulage. So how can you basically switch out diesel for hydrogen? And so we've actually been working really hard on this to put in place the first sort of hydrogen-powered haul truck. So hopefully that will be on site at the end of this year in South Africa, which would be really exciting.
My word.
So, using the overcapacity from renewables generation to create hydrogen that can then be used basically to displace diesel. So in a wanna, you've kind of got your scope 1 and your scope 2 there. So I think renewables is such a cornerstone. It needs to be for everybody. I think the other thing that I think most bang for your buck is basically about thinking differently. So in mining, sort of innovation historically has been about how do we dig a big hole quicker, deeper, faster. But it's how we completely, as we sort of talk about at Anglo, reimagining mining. So how are we thinking about mining with a completely different footprint? How are we thinking about the energy? Huge amounts of energy in the mining sector go on comminution. So breaking big rocks into smaller rocks. There has got to be a better way to do that process. And that's absolutely a kind of key part of the future smart mining approach, which is how are we just rethinking everything with respect to energy, water, footprint, efficiency, productivity. All, it's not just about productivity, it's thinking about all of these things together with the same weighting that we can then really kind of rethink, reshape how mining actually undertakes a lot of its processes, leading to, I wouldn't call them ESG outcomes, I would just lead to sort of increased efficiency, productivity, and financial outcomes, which is, as Matt's already said, with the cost of electricity coming down, if you're saving money on electricity, if you're saving money on water, if you're saving money on your processing, it's going to have a kind of cumulative, very positive outcome environmentally and financially as well. So short answer is renewables have to be part of the answer, but companies need to not think as they've always thought and think about incremental change. It's about really thinking about things completely differently and seeing what those opportunities are in the decarbonisation space.
Froydis, thank you very much for sharing that experience with us. That's I'm going to love to hear about the trial of the truck. That's brilliant. Thank you. I'm wondering if I can pivot slightly and talk to the panel a little bit about divestments and what influence, if any, you think divestments are having in driving low carbon technology or offsets. Does another investor just step into their shoes, or actually is it resulting in tangible change, do you think? I might ask the investors first and then ask for your thoughts, Gloria. But Matt, do you have any perspectives on this issue? How important are divestments?
Yeah, it's an interesting one. I mean, you can use coal as a pretty good case study because that coal and other fossil fuels like oil and gas really have been at the forefront of divestments. We've seen large pension funds globally, divest those over the past couple of years. And I think where we've ended up is, I think there are other investors who've stepped in, different ESG focused. They might be private equity focused or more trade players. But what we've seen with those fossil fuel companies is they are now structurally trading at lower multiples and lower valuations than they were before, and against the rest of the market, especially some of the players in, say, the battery materials space, which is seen as a good ESG sector to be in. So that's going to affect the cost of capital. You've had banks kind of walk away from funding large parts of our sector as well. So the ability for them to grow and execute new mines is a lot harder. It doesn't mean that when the coal price goes up, coal stocks don't go up, because we've seen that lately. Interestingly, Freud mentioned Thungela, I hope I'm saying that right, but that spun off the other day. That was down 10% on day one, which I think was seen as a win for ESG investing, and that big investors were divesting it. But then on day two, the stock was up 30%, as other investors stepped in to maybe take advantage of the bargain there. So I don't think the stocks die or go away. I think they probably end up in different hands, and it certainly makes growth a lot harder. The interesting thing is going to be when new supply doesn't come through and there's still a need for coal and oil and gas in the near to medium term. Does price spike, and what does that mean? And does that actually ultimately accelerate the decline of these fossil fuels, because the cost gets a lot higher and it accelerates the shift towards renewables? So that's going to be an interesting dynamic for the next few years, and how investors sort of approach that, I think.
Yeah, Matt, thank you. Just Stephen, do you have a perspective on divestments and how influential or otherwise you think they are?
Yeah, so we have some divestments. So we've divested from thermal coal and tar sands, on the basis of climate performance, and how they're very unlikely to be compatible with a low carbon economy. That's the economic and scientific modelling is pretty clear on that. But the reason we divest those is not so much a kind of realpolitik play to try and put them out of business. It's much more of a clean hands approach. So we're sending a message with those divestments rather than deliberately trying to affect their business. I think in terms of actually driving the transition, we think engagement is much more effective, and denying debt is likely to be much more effective. So our investment restrictions carry across to our fixed income investments as well.
Yeah.
And I think in terms of engagement tools, we're trying to use all of the tools available to us. So that's working in collaboration with other investors, defining standards and frameworks that apply to the mining industry, that can rally investors around a core set of asks. We're engaging with policymakers, and trying to kind of socialize expectations that can filter through the market. So whether that's investors or bankers or insurers or others. So there we go.
Thank you, Stephen. Gloria, do you have any thoughts or perspectives on this? How relevant or important is divestment to driving decarbonisation?
I think in the short term, like we've seen Matt and Stephen talk about, it can ebb and flow. There'll be ups and downs. I mean, there'll be financial decisions, but I think longer term, it's that climate risk management, it's that reputational risk management, it's where you'll see your business heading in terms of whether or not you'd pick up that coal mine that was offloaded last week. It's definitely a financial decision, but it's also that longer term view. And I think as the economy transitions to a lower emissions and net zero emissions future eventually, there is going to be that risk of, is that going to be viable in the future? Is that going to give the returns to my shareholders that I need to, if that's something that I'm looking at investing in, and why am I investing in that? But again, to Stephen's point around that education piece and engagement, I think that's a lot more important and can have a lot more, I guess, benefit in the longer term.
Thanks very much, Gloria. I'm just going to ask the panel on one last topic, and it's really this question about whether there's a path to convergence around decarbonisation. Stephen, do you have any thoughts on that? And if there is a path, who should be responsible for defining and verifying a common industry framework?
Yeah, I think we're starting to see convergence, at least at the investor level and corporate governance level. So convergence around the assessment methodologies that investors are using, TPI, Climate Action 100+, are kind of consolidating investor asks on the net zero investment benchmark, for example, of CA100+, and TPI's assessment methodology. So I think there's kind of increasing convergence there. Who's responsible? Well, institutional investors, asset owners, endowments, sovereign wealth funds have a really important role to play sitting at the top of the investment chain. Governments as well. are arguably primarily responsible for kind of system level risk and system level controls. So, COP26 in Glasgow is going to be a interesting forum for further action, further consolidation. Yeah.
Thanks, Stephen. Matt, do you have any perspectives on the issue of convergence?
Tim, I guess from my perspective as more of a generalist investor, it's probably a little bit too technical for me to have any firm views, but I do agree with some of the things you're saying in the intro about, the number of acronyms, the multitude of different frameworks that are out there. I think convergence is needed just to simplify things for people who aren't ESG specialists, and sort of get more investors and more companies on board. So I'll probably leave it to someone who's a bit better informed than me to.
That's fair enough, Matt. Yeah. I mean, there is this issue about specificity and flexibility around standards and frameworks and risk assessment frameworks. I'd be interested in whether there's any thoughts on what's the right balance there. Froydis, do you have any perspectives on that at all?
Yeah, I think from a company perspective, when we get, there's lots of indices that we have to work with, investor requirements, these things are really quite detailed. And it's not that we don't want to provide the information's kind of there, it's sort of packaging it up for their indices or for their algorithms or for their kind of frameworks. Yeah. So I think it's two-sided, really. I hope that we do get that more convergence, and I think TCFD and I think the Climate Action 100 net zero benchmark is really good because it does, it lays it all out there, and they are tough questions, but rightly so. And so I think those are really, really helpful. And then from the company side as well, I think we all need to be better at presenting our information. So, we work really hard at making, being very transparent across a whole range of our data and our information, not just environmental data, but also tax and economic contribution. We're very, very transparent. And it's how we can really make sure that the information that we're putting out there is accessible, is understood, fit for purpose, and actually then supports the kind of information that the investors are looking for them to make informed, well-informed, responsible decisions.
Thanks, Froydis. Gloria, just to finish off, do you have any thoughts on the convergence around decarbonisation and standards, particularly for the mining industry, but generally as well?
And I think more generally, TCFD, we mentioned a lot today. I mean, that's a great example of an initiative that's really a framework there for reporting on climate risk, and it has really had a lot of uptake and is improving as well in terms of the quality of those disclosures. I mean, initially it might have just been, yes, let's take this framework and quickly write a report and release it. But I think importantly now people are actually looking at it in more detail, delving into those scenario analyses, which they're actually using to inform investment decisions rather than just saying, here's my scenario analysis and I've done the report. But the other one, just throw another acronym before we finish today, the SBTI, or Science-Based Targets Initiative, is another one that's currently being developed, and that's really looking at a global net zero standard. So, when you get two net zero commitments from two mining companies, if you dig behind them, they're going to be quite different. So the standard here, I guess, is looking to put some guiding principles, some recommendations on how companies themselves can actually set those science-based targets, and it really with the primary objective for striving for a common understanding. So what constitutes net zero, and how do we drive really the adoption of those credible claims? So I think that framework's coming out just before COP26, so a little bit later this year, and looking for consistency across those metrics, like what are the emission scope inclusions, 1, 2, or 3, and how much of them? What's the defined boundary? What are the timeframes? Do we have interim objectives? What are the market strategies being employed? So I think that tool will be useful both for companies doing their targets and identifying their decarbonisation pathways, but interestingly as well for investors who are actually picking up these targets and sustainability reports, and we're just wondering what is it that I'm looking at here, and how can I compare, two companies' different commitments when they're saying they're both going to be net zero by 2040, for example. So, it's important to have these frameworks. There's a lot of them out there, but I think you also need to have just flexibility in there as well. If it's too prescriptive, you run the risk of people really not, taking up their practice approaches and just shying away from it. But, if we have really good, credible frameworks, then that can be a bit of a North Star that people can look to and, backed by science as well in terms of what's required to achieve the change that's needed. So, yeah, SBTI, there's the last acronym for today.
Well, thank you for that acronym, Gloria, and thank you for your response, and thank you to all of the panelists this evening. I've found it a most fascinating and stimulating discussion to hear from all of you. And also thanks very much to Minds and Money for organising the event.